Hi, Mark here from Hamilton Court. Welcome to FXcellence. In this series, we're bringing you the key themes of strategic risk management, but without getting stuck in the complexities. And today we're talking about what moves the market. Nothing moves quite like the foreign exchange market, and it's widely considered the most liquid financial market in the world. A trading day could well see the equivalent of $7.5 trillion being exchanged. But what are the four things that market participants, or buyers and sellers, might look at? There are fundamentals, there's technical levels, there's domestic and geopolitical events also to consider. So from the top, one of the key drivers behind price action is fundamental analysis. Since this is an umbrella term really, what does it actually involve? Interest rates and expectations of which way they're heading, monetary mechanisms like quantitative easing and quantitative tightening, inflation, labour market data, and in addition to that, their impact on growth and output data, which includes information like GDP, unemployment and wage price inflation. A country's current account and their balance of payments, which is to say how much they're importing versus how much they're exporting. And then up next is technical analysis. But what does that mean? In short, it's the study of levels, patterns and mathematically derived indicators. But how does that help? Well, essentially, it's all about looking at these levels and these patterns and making an assessment on the direction of prices at certain points in time. From this, traders will consider whether certain exchange rates may act as support or resistance for a currency pair and then place their bets accordingly. It's important not to overplay the impact that domestic political events have on the markets, but we shouldn't underplay them either. Election cycles, budgets and referendums may well influence the market's view over the trajectory of an economy in relation to growth, trade and investment, inflation and interest rates, and in turn impact the buying and selling of the country's currency. But in an increasingly globalised world with interconnected financial markets, it's always important to consider the bigger picture. It's important to consider how the geopolitical climate can feed into risk sentiment. Some of these factors could be conflict or the threat of conflict, or an escalation to an existing conflict, trade wars between countries and regions, the impact or likely impact of sanctions and embargoes, economic blocs, international relations and trading policies, and major powers' foreign policies and where they choose to invest their earnings abroad. We'll save the best for last and say that what we've seen over the last few years are more and more black swan events, which by definition are unpredictable, unforeseen, and typically have extreme consequences. COVID is an obvious example, as is the hand grenade that Kwasi Kwarteng decided to throw during his very brief time as Chancellor. And it may just be us, but these things feel like they're happening a little more frequently nowadays. The point of all of this is that even with the best crystal ball, you'll struggle to foresee everything that might move a market and impact your business. But having an FX strategy in place is a great way to be prepared for what the world might throw at us. We're here to simplify FX. Get in touch with one of our friendly and knowledgeable experts and let's see how FX strategy can drive commercial impact in your business.